to day 2 of the Credit Suisse ASEAN conference in collaboration with the ASEAN exchanges. I'm Nicholas Tay. I cover the Singapore banks for Credit Suisse, and we'll be kicking off the day with a panel looking at digital banking in the region. Digital banking is something that's been growing globally over the last several years, with more digital banks being launched. In ASEAN, we're definitely in store for more digital banks, particularly with the licenses being awarded in Singapore in early December, and likely more countries to follow suit as well in the region. So, let me go ahead and introduce our 4 distinguished panelists today. Firstly, we have Mr. Varun Mittal. He is the partner and global emerging markets fintech leader at Ernst & Young. Dr. Dennis Khoo, who is quite an experienced digital banker. He's the former head of Tomorrow Digital Bank at UOB, and he was the CEO designate of one of the applicants for a digital wholesale bank in Singapore as well. So quite a few years of experience in the digital banking space. Thirdly, we have Ms. Supaneewan Chutrakul. She's the Executive Vice President and Division Head of Integrated Channels and Business Solutions. And last but not least, we also have Mr. Marc on the line. He's the CFO and VP of Strategy and Investments at Singtels International Group. Singtel obviously being part of that Grab Singtel consortium that won a digital full banking license in Singapore just last month. So, let me start off the session firstly by asking Dennis and Varun, if I think about the banking space in today's environment, most, if not all, banks essentially already have a digital strategy or digital transformation strategy that they invest millions of billions in every year. So, what's your view on how digital banking is different from the modern banks that we have today?
So, Nicholas, great question to open the conference. As you indicated, basically, what is the difference between the digital banking initiatives of the incumbent banks and those that are coming up of the newer banks or standalone banks? My view is that actually there's a very big difference between digital banking, which everybody has, as you say, right? There are very few banks today that are leading that don't have a digital bank offering. But the incumbents come in with something very different from the new startups or the new banks, because I think overall it is much more than just digital banking. It's much more than technology. It's really about creating an experience that's very different. And in the space that we're talking about, it's not like you're going to read or invent a bicycle where the bicycle hasn't been invented. So there isn't going to be such a big 5x difference between walking and cycling. And therefore, a lot of the focus needs to be on taking a whole bunch of stuff that's not quite perfect and perfecting it. And taking those 50, 80 things that you see that are not perfect and perfecting it would really allow a bank to really transform the experience. So at the kind of transformation we're talking about, I think there is a big requirement, not just from the technology perspective, which is obviously important, but from a cultural perspective, from a design perspective, from a journey perspective. All that has to come together in a way that really allows you to create an experience that customers can feel is going to be very different. Otherwise, it will be very difficult to differentiate. So in summary, I think the big difference in the digital bank and digital banking, which I think is a very important concept to understand, is that in the digital bank, it encompasses much more than the technological element of launching digital banking. It's really about the culture, the focus on customers' experience. It's about design. It's about the journey analysis. It's about the attention to detail. Putting all that together in a compact that allows the new bank, the new offering, to really produce an experience that's going to be phenomenal in terms of allowing a very high measurement in advocacy like Net Promoter Score. And that is the basis of how these new banks are going to compete.
So, Nick, the way I would look at it is what's happening is the current digital banks, the current banks which are coming digital, what they are looking at is they are trying to map existing stuff to the new world. So I'll give you a very simple, basic example. In the old world, you would have different, you would not have digital banking. So as a consumer, I have a retail account, I have an SME account, and I have two separate checkbooks. What the traditional banks have done is they've mapped it. So now if I'm somebody who has stakes in two different SMEs, then technically I have 3 login passwords, one for my retail account and 2 for my SME accounts. But if you map it to digitally native companies, if you see you have any email ID, you can have multiple email IDs, multiple social media accounts, all connected to the same password. You can have multiple Facebook pages, Twitter pages. You can have one unified identity connected to different. That is when you have building a digital first solution, which is not constrained by the guidelines or by the structures from the past. Another example is traditionally, because the cost to serve was through branches. So you are rich, you have one RM serving 400 people. You are very rich, you have one RM serving 50 people. You're super rich, one RM serving 10 people. You're not rich, DIY, go to the branch queue. In the digital world, what's happening is if my video streaming app is same, my e-commerce app is same, my food delivery app is same, then my banking app is also same. So the premise of where you do not have a segmentation on access to services. The access is same, the pricing may be different. People understand I'm buying 10 tissue rolls versus 1 tissue roll, I may get it cheaper. But the access segmentation, which traditional world, they cannot get away with it because that's how the structure is. They cannot dismantle it so easily. The digital first people can start with that because they know the Netflix and Spotify for all these customers is same. So they want the same experience. They would not want. And specifically, when the digital banks are attracting new customers, as Marc would, for example, be doing in a year, nobody will move all of their wealth on day 0. So which is why even the rich person will come with a smaller part of their wealth and then progressively it will grow from there. So which is why ability to give that consistent experience without creating artificial segmentation, which in the old world was constrained due to the branches and the RMs, but now with the digital and digitally assisted, you can have the benchmarks are much higher for everybody, not just the poor guy. So which are some of the core differences. Everybody can have a mobile app. Everybody can have a digital robo-advisor. Everybody can have a digital lending onboarding. Those are, I would say, table stakes. But the core philosophy of how you approach a digitally native approach is what is the difference between the new digital banks and the banks who are becoming digital.
Thanks, Varun. Thanks, Dennis. I think building upon that, Marc, when you guys won that digital full banking license last month, I think in your press release, you highlighted some focus groups that you would be targeting initially. To mention a couple of them, the time-starved young PMETs, gig workers with flexible incomes. Could you share more detail on the size of the opportunity you see here? And also, I mean, when we're talking about serving them as Varun and Dennis mentioned, could you share your thoughts on how you can serve these segments better and also, I guess, more profitably than the incumbents are already doing?
Yeah, thanks, Nicholas, and a pleasure to be on this panel. Let me offer a couple of perspectives from our vantage point. I think number one, if you look at the MAS framework for the digital banks in Singapore, there are 3 phases, right? The first being the entry or the restricted phase, and this is part of a broader gradual progression for new players into the banking sector. I think as such, there is a big focus on the existing ecosystem of the sponsors targeted at the customers and the business partners. And this would be subject to certain restrictions in the entry phase. So for example, the retail deposit cap is 50 million, right? So that's the first kind of perspective. The second perspective, I would say, is that while Singapore looks to be a mature market from a banking, or a banking account penetration perspective, there have been numerous studies done, including the recent Bain, Google report, which did highlight, customers, both retail as well as SMEs, can be better served. I think we appreciate that, Singapore as a market, it's not unserved, but there is definitely an element of how you can better serve the customers, building upon what both Dennis and Varun had mentioned. And so we do think that there is a customer pain point to be served, particularly in the segments you've just mentioned. The third point I would mention then is that actually, if you look at our ecosystem, the consortium of both Singtel and Grab, Singtel has over 4 million customer base in Singapore alone, and Grab, as you know, is one of the most downloaded apps in Singapore. So I think the general direction is, we hope to leverage off the customer base, our understanding of our customers through the existing journey, provide faster speed to product launches, etc. And we think that through this kind of economics of scale and lower customer acquisition costs, that's how you can serve or you can basically service this segment more profitably. I think added to that, this is a pure and new digital platform, so it will not be saddled with any legacy systems, physical infrastructure, and they would be, the bank would be able to leverage off the digital capabilities of both sponsors. The last point I would make is that I think what's critical and important is that the customer knowledge and analytics, which hopefully would allow the bank over time to make more customized offers, which is relevant to the user. And through that, we hope to be able to offer a more comprehensive service across the journey they already have with us, which is transport, food, telecommunications, and digital entertainment. So that's kind of the quick perspective. Yeah.
Thanks, Marc. I'd like to move on and talk a bit about technology and the role that plays. But firstly, Khoo Supaneewan, I think, can you talk to us about KBank's digital transformation journey and, how you've been able to enhance your tech capabilities?
Hey, good morning. In terms of the KBank, we have a spin-off our IT department out of the bank about like 4 years ago, which at that point of time, we are aiming to have the IT technology guys to be more flexible, to be able to move onwards faster than they are in the traditional banks. And after 4 years, we have been doing a lot in-depth integrations with partners. The good thing is we have done end-to-end from research lab that we are testing about all the customer experiences to the develop the applications or develop all the services until we launch it. And when we launch the KBTG people, they are launching with a KBank. And now we are also having another company actually will help us to kind of using those technologies to launch in other areas or other industries. So we actually not serving only KBank, but serving other company as well. So from our journey of the IT spin-off, it's helped us to, one is, I will say that IT guy will be closer to the business as well. So they are closer to the customers. They are understand more for the people business people. So we are work very closely for that. And we have done a couple a lot of partnering because we are believing in partnering with our partnership. For example, Grab, Facebook, Line that we are working together. So we have IT team working together, more flexible, in depth of the integration. So to actually at the end of the day, we have to better offer the experiences to the customers because Mr. Khoo say, there's not such a from my point of view, there's not such a online or digital banking. People just looking for where's the best experience that they want to use. If they want to use these applications, how we are paying easier, don't have to remember anything, how they make all the transactions happen much faster. That's all what they want. They're not really looking this is digital, this is traditional. They're just looking for the experiences.
Thanks, Khoo Supaneewan. And I think building upon that, Varun and Dennis, as we had mentioned earlier, the banks are already investing quite a bit in their own technology. Obviously, on the surface, what is being seen or what's sort of expected is the non-banks have better tech capabilities, but with so much investments from the banks themselves going into technology, could you give us your view on the role that technology plays, and also do non-banks really have such a big advantage from this angle?
See, the way I look at it is, it's not that non-banks have access to a technology which is not for sale. There is no, I mean, yes, they may have data about customers' habits and behaviors, but there is not like a absolute patented technology which only non-banks have, which banks don't have or cannot afford to rent. It's a question of what you can do with the technology. So it's like everybody has knowledge. Internet teaches everybody to be studious. Everybody can study anything from Khan Academy. Doesn't mean everybody becomes a scientist or a researcher. So, which is why it's not the access to technology. It's about ability to use the technology. And I'll give you a simple example. A lot of traditional banks, you have to make a huge case for CFO to write off that, because you bought something with 10 years ago or 5 years ago with a 10-year life cycle on your books, and technically you have 5 years left. If you want to replace it, now you have to submit a case for write-off. So accepting that write-off is not that easy in most scenarios. So which is why it's a question of how can you embrace it? And banks have figured out ways. Most of the banks, large banks, are already embracing cloud. They have already done digital KYC. But it takes time, because you see, when you have to move a large ship, you cannot turn it around as fast as you can do with a motorboat. But the ship turns, it just takes slightly more time. But I don't think any of the non-tech or a big tech has access to a elixir technology which a bank cannot afford or access.
So, Nicholas, I agree with Varun in terms of the, basically, I don't think banking technology, right, having been in banking for almost 20 years, is really that different. I think the key difference is that, like aviation, you can't make a mistake. You can't, send someone a balance that isn't correct. You can't not fulfill a transaction exactly for the amount required. So the real issue, I think, for the traditional banks is that they have a much bigger business. They've got a lot more customers. And the way that the infrastructure has developed, I think one of the essential points in banking is that on the back end, there are multiple systems. It has never been a case where you can find one solution to cater to everything. So at the back end of most successful mid-sized banks, you may have 50 to 100 different applications. So there's one for the core banking deposits, there's one for credit cards, there may be one for personal loans, there are one for mortgages, and you have a customer management system, you have credit systems, you have risk management systems. You have a lot of systems at the back end that need to be put together. And over time, as you have acquired the infrastructure, I think it becomes harder and harder, for example, do the testing. And also some of the ways that the banks have developed, right? For example, in trying to compete, banks have really focused on micro-segmentation. And therefore, you have high headline rates with a lot of terms and conditions that all need to be coded. Now, if you think through the number of channels in the omni-channel bank, if you think of the number of systems there are, if you think of the number of products there are, right? There could be like 20, 30 different credit card products. If you think of all the headline rates and all the rules you need to put in all the conditions required to make those headline rates, it's very complicated. You end up with a very huge legacy kind of infrastructure that's very hard to enhance, it's very hard to test. And that is the essence of the issue, not really the technology itself. So I think where the new players come in is really, they need to simplify all this. If you are going to start fresh, right, but you don't make those design changes to the way you're going to offer the products in terms of the simplicity, in terms of the way you have done the coding, then over a period of time, it is inevitable that the new will become the old. So I think the key here, back to my point, right? Technology obviously is an enabler, but the key is back to how do you design the offering? How do you design the proposition? How do you design the bank from scratch, right? And so that you avoid a lot of these issues, because if you don't put in the design to do this, then inevitably over a period of time, you will end up in the same place where all the incumbents are.
Thanks, Dennis. Thanks, Varun. And Marc, you mentioned it slightly earlier on in your answer, but could you, I guess, give us a bit more detail on how the consortium's digital bank will leverage off the existing tech capabilities at Grab and Singtel, and how quickly, or how, I guess, what would be the estimated initial investment into the digital bank?
Yeah, sure, Nicholas. I think as part of our own digital transformation journey, both ourselves and Grab have built up various digital platforms. So on the Singtel side, we've built up the Dash, the mobile wallet, which was actually our version of a digital bank, which started 5 years ago. We've moved on to all digital, no contract SIM-only products, digital advertising, cybersecurity, enablers, for example, in the area of data analytics. And then likewise, for Grab, they started out as ride-hailing, but then have moved into food delivery, financial services, but with a very key focus on keeping high levels of engagement with the customers. So we think that we hope to help the DB or the digital bank get a head start through these various experiences, from the digital businesses which we've had. So for example, we recognize that customer data privacy and security are very important in the case for digital banking. And that's something we can leverage off our cybersecurity experience, right? I think the second example, which I think was mentioned by both Dennis and Varun, building a bank from scratch requires a fair amount of design, tech architecture, ranging from the front, mid to back end, as well as system integration, across. And that's something we believe both Singtel and Grab have that experience, of course, in our respective businesses, in building up some of these capabilities. I think the last one I would say is that it's important to draw the necessary insights through our collective data platforms, right? And that's how we can perhaps serve customers better. Now, I think on your question relating to how much is the initial investment, I would say it's fairly modest. Just to give you a sense, as I mentioned earlier, the total paid up capital, per the MES framework for digital bank, it's 1.5 billion, but this is only at a point in time when the bank becomes actually a full bank, right? And this will be kind of several years away. So that there's a phased gradual progression in terms of the capital commitment. As I mentioned earlier, the first 1 to 2 years, which is being defined as the entry or the restricted phase, the minimum paid up capital to operate the bank, whether retail or wholesale, is fairly modest, right? So for the retail, the minimum paid up capital is $15 million, whereas for wholesale, it's $100 million. So it's fairly modest, I would say, and so over time, then more capital will be contributed.
Okay, and I guess the assumption is you would come in at a much larger amount than that 15 million, perhaps like 100, 200 million kind of level.
Yeah, I would say that we'll size up versus the restrictions put on the bank. So for example, as mentioned, there's in the entry phase, the retail deposit cap is $15 million, right? So that in a sense would size up the kind of capital needed at the outset. Of course, at the same time, you have to kind of fund OPEX, staff costs, CAPEX for building up of systems, etc.
Okay. Thanks, Marc. I think sort of building upon what you said about the insights into customers, of course, a lot about the data that comes along with bringing a non-bank into the industry. And I was thinking about having a different way of credit analysis is something that people are looking at for or hoping that the new digital banks could do. I guess a question for Marc and Dennis, if you could talk a bit about the role of data differentiation for a digital bank, and how successful or reliable can some of this alternative data be for credit analysis?
Well, my experience has been that it can be very effective if you get the right kind of data. And the data you are looking at is really data that can basically give you a better picture of the client's ability to repay. And for individuals, that there will be some association back to the lifestyle, the habits, and the associations, right? Who else does he associate with? For businesses, obviously, I think one of the areas to look at is really the information the business already has in their accounting systems that give you a much better perspective of what their accounts receivable and accounts payables would be. My personal view, not having worked in Singapore, is that every country is slightly different. In Singapore, I think it's going to be very difficult to use data because on the retail side, the conditions, I think, in terms of having the bureau and the guidelines that permit where you can land and all that are already fairly well defined. So my personal view is that on the retail side, there will be more limited opportunities available based on the demographics that we're dealing with and also the already very well understood guidelines in terms of what is the minimum income requirements needed and so on and so forth. On the SME front, I think in Singapore there's a lot more room because the bureau isn't strong, isn't as strong as what you have in retail. And I think the methods that banks use to underwrite businesses is still not up to mark in terms of being able to accurately ascertain the ability to repay, especially in small businesses. And this is going to be varied by countries. My own experience, coming up with an alternative credit scoring model is that the telco data tend to be quite good. And any other data that, for example, can show the proximity of the borrower in terms of his work location, his home locations, because these tend to also be ways to validate that it's not a fraudulent application. And these have, I think, worked very well in the China context and also in the Indonesia context, where I think there is a much larger geographical spread. And I think there's still a lot of opportunity to grow and expand the market.
Yeah, and Nicholas, I think maybe just to add on to what Dennis has said, on your question of, what is the role of data differentiation? We think it's actually quite important. All digital bank players will have similar aspirations, right, for customer value proposition. I think Dennis mentioned earlier about, it's not like there'll be a 5x change in a loan is a loan, a deposit product is a deposit product. But I think what's important is, how is it enabled by data to deliver, relevant, contextual, timely services embedded in their own customer journey. So there's this whole big thematic about, embedded finance, and I think that's something we're quite excited about. From Singtel and the Grab consortium, I think I've already mentioned about the customer base. But for example, in the SME space, collectively, we have more than 100,000 SME customers, right, across many different verticals. You'll be very familiar, of course, with the merchants by Grab, but Singtel has many SME customers as well. So we do think that our collaboration is something fairly unique, but there's, it's still early days and there's a lot we need to kind of work through. But the ability, for example, to have, faster, real-time fraud detection, getting a better sense of customer risk appetite, I think that will all really help in differentiating the bank. So, in short, we think that it's actually going to be one of an iterative process. I think the more engagement you have, the more use cases, then, the DB, because it doesn't have any legacy, would be able to build on that base. And I think the aspiration, obviously, over time is you can reduce the number of clicks, reduce the application timing, the process, minimize human intervention, and automate and digitize as much as you can. All right. But I think the one thing which is very important to also highlight is that while it's important, while data hopefully over time would differentiate the banks, we also do, focus a lot on security, cyber attacks, etc. And that's something we place a huge emphasis on.
Thanks, Marc. Thanks, Dennis. And Khoo, Supaneewan, from KBank's perspective, could you talk about, the bank's view on alternative data and, how you guys have managed to utilize it successfully?
I think from the bank sides, all the banks, we have a very rich information in terms of the financial sides. All the, these people is rich, they have AUM, those kind of stuff. What we will have from the alternative sides, and we are working with our partners, it will be more of the discipline that they have, like ability to pay, are they willingness to pay, those kind of stuff that will help all the process of the lending become more successful. Because you can lend, the rich people doesn't mean that they have a more discipline than the poor one. So basically, those data will have we have financial rich data. We work with all those partners who have a very good a behavioral data. We also have just joint investment with Line to have a company to actually a lending company. Basically, we just launched for a month, and we have like 1 million customers already, on onboarding, and we have are reaching a lot of a number of customers to actually using kind of credit scoring model that is not based basically as a traditional a financial base more of the data. So it's still a beginning. We see that there are data that will help to show the behavioral and a discipline of the customers. It will help after we actually give the loans to the customer whether their behavioral have changed, which will show the early warning signs before it's become bad one. So I think we see all this coming, but it's still a beginning of the portfolios that we have to follow ups with all the data that we have more and more, and it will become more important in a very near futures, because in Thailand, basically payment margin is very thin now. All the peoples are focused more on the lending parts, and lending parts for the kind of for consumer sides. We see the market is huge, but those who are in financial institutions still very small. So that's still a very big opportunities for all the financial institutions. And also the SME one, we also see all those behavioral through through our partnerships, basically, because our customers, also our partners' customers, we have very rich in some part of the data. Partners also have a very rich in the other part of the data. So I think it's a combination of what we have, what our partners have, and how we can mix that to make it the data to be a useful data, because doesn't mean that you have data, it will be useful in the whole text of the data. Yeah, I think we see that it works, but it's still at the beginning, and we still have a lot of work to do onwards. Yeah.
Okay, thanks for that. I think if we move on to the other side of things, in the non-interest income side of a bank, Varun, you've worked with, I think, quite a few digital banks and fintechs globally. So I guess when you're looking at the space, whether in general or specifically in the ASEAN region, can you talk a bit about where you see the biggest gap for opportunities, perhaps on the fee income side, for some of these new digital banks?
We look at what are the key fee income products outside of credit card, because that's still connected to the ability to lend. You have mainly is wealth related products and insurance related products. And today what happens is when an existing bank gets paid $500 million or $1 billion for a bank assurance deal, then technically somebody is paying for it. It's not free money, right? So that cost is actually then that translates it downstream all the way to the consumer, what the cost of consumer is paying. And since digital banks will not have those branches, so they will have to look at bank assurance in a different model. So there will be new models in terms of revenue which will come in. And also, how do you distribute those insurance products? How do you offer those, as Marc mentioned, embedded insurance products? The other part is wealth. And interestingly, you don't need to wait to get the banking license to start the wealth business, because wealth business is governed by separate licenses. And in most cases, most banks are not the asset managers themselves. I mean, they may have an asset management arm, but even if they have an asset management arm, they don't sell only that asset manager's business. They sell other people's stuff as well, because you want the full broader exposure. So which is why the wealth side of the things, they can already scale up. And that actually can be a segue. And which is why if you would see that some of the applicants have already launched the wealth businesses ahead of time, 6 months, 1 year, 18 months ahead of time, because that helps them familiarize with the customer, that helps them with the first round of KYC, bring some AUM in. So I personally believe, specifically in a developed market like Singapore, the fee-based income which can come from the wealth side of the business, and not just the passive wealth, because now consumers are looking for that, can you help me get access to other asset classes? Which is why you see existing banks getting into crypto and security tokens now as an asset management business. And that's much more, the spreads are way more higher in, let's say, a cryptocurrency versus a US stock exchange. What are the alternate asset classes can you offer me? Can you help me access startup stocks? Can you help me access new asset classes like art? Even younger consumers understand it. I was talking to one of the interns in my team, and he was looking to invest 10K in a wine storage company, where he can have 5% of one barrel, which he can unlock in 5 years from now. So which is why these are, I would say, much more higher margin products. And today the access is limited to super ultra high net worth individuals. Anything less than 15 million, 10 million AUM, your private bank won't even talk to you about it. And bringing all of that access, which are much more high margin, and because you're bringing them first time to the market, those for me will be the biggest drivers of revenue in fee-based income for the new digital banks.
Thanks, Varun. So we're moving in quite close to the last 10 minutes of the session. So for the audience members, you'll be able to see an email address at the bottom. If you'd like to ask a question to our panelists, please do send your question across that email address, and we'll try to get your question answered. But in the meantime, I think while we're waiting for those, perhaps we could touch a bit about the angle of the business model for a digital bank. And firstly, I guess, asking Marc, could you share some details on the path to profitability for the Grab Singtel consortium? And when do you estimate that to become profitable?
Yeah, thanks, Nicholas. I think a clear path to profitability is one of the key criteria, by the MES. And I think as we've kind of mentioned, it's to ensure it's viable, sustainable, but also to prevent any kind of predatory pricing, right? And I think ensuring financial stability is something quite important. I would say that at this stage, we won't be able to share in terms of what year we expect to break even. But we do agree that the path to profitability is important. And I think per what MES has mentioned, it's something we will follow quite closely. I think what I would say is that how can a digital bank have a path to profitability sooner rather than later? I think one is, a new player would and ought to have actually a lower cost structure. And particularly if it's enabled by sponsors with ecosystems, because that would actually lower your customer acquisition costs, which can be reasonably high if you did not otherwise have an ecosystem. I think that's the first point. I think the second one is that, and some of the other speakers have mentioned it, you're building from scratch. So the benefit of that is that you have no legacy or incumbent systems. I think Dennis was trying to give an example of aviation. And the illustration we sometimes talk about is, you don't want to have to change the engine while the plane is flying halfway through. Right. So I think, through these various, pockets, we hope to be able to have a much lower, cost to income ratio over time. And that would help improve the path to profitability sooner rather than later.
Thanks, Marc. And Dennis, you've worked with UOB, and you've basically launched a couple of digital banks in the region. I just want to get your take on as well in terms of what you've experienced for profitability of a digital bank.
So, Nicholas, it's a pretty simple question, but actually the answer is fairly complicated. I think the first thing you need to understand is the segment you've chosen, right? if you have chosen the younger segment and there are good reasons to choose the younger segment, then you already have the onset, what you have really decided is that you've actually kept your revenue, because in the early stages of that segment, in their younger days, they're likely to generate less income. Whereas if you're going to target the more affluent, it has other problems in the sense that they have a much bigger preference for omnichannel. In the areas where more advice is needed, like wealth and mortgages, there is still a role for giving advice with people rather than just digitally. And of course, the number of people you have access to in terms of customers, the mortgage and investment business are very window specific. If you don't get people in the right window, then you miss the opportunity. Not so for the transaction business, because everyone living in the modern economy needs a bank. And therefore, the first criteria is understanding who you have chosen and the revenue potential of that customer, which is going to be very hard to change in the short term. And therefore, for the young professional segment, right, you need to really focus on your costs and your cost of acquisition. And I would say that the most important point in the cost of acquisition is not how much you're going to pay the customer, because that method is unsustainable long term. The most important thing you need to figure out is how much you're going to spend so that the advocacy measure, which is really a measure of how good your experience is going to have an impact, right? If we assume that, and this is actually data available from Bain in terms of the Net Promoter Score for retail banks in Singapore, I think if I remember correctly, that number is about 20. And if you take out the lead contender, which is POSB, because there are other reasons in terms of history, then that score probably drops to 18 or 15. So whoever is going to launch, you need to launch at a Net Promoter Score of 30 or 40, so that you create that difference in experience that allows you to acquire active customers at a much lower cost of acquisition. That is the actual KPI that you need to set when you first launch. Once you have a big enough difference in advocacy, then you're going to be able to acquire customers at low cost. And that's when you can consider that the base of the partners that you have would then also, in addition to the fact that you have a big advocacy gap that helps you, also reinforce the fact that you can acquire at lower cost, and not the other way around. So this is a very important consideration that most people may not be thinking about, may not be aware of. And it goes back to what I was saying earlier, because you are not going to make one big move that's going to give you the 5x functional difference that you see, especially in the transactional area. In terms of what Varun was mentioning in the investment area, in the mortgage area, it may be possible to create that, because the innovation there, I think, has been weaker. But that segment has other problems in the sense that it's mostly a segment that you need to be very window specific. You need to understand when people are going to buy a house, when they're ready to invest, and therefore that creates more problems in terms of your ability to scale up. But my advice would be for both the banks that are starting out as neobanks or the incumbents, the single biggest thing you need to think about is when you actually launch the service you're going to launch, what is your differential gap between the experience customers currently have and the experience you're going to bring out? And I would say that the minimum is a 2x differential in your advocacy. And that sets you on the right path in the ability to acquire active customers at low cost. Because if you don't start that way, you're not going to get to positive marginal contribution. And if you don't get to positive marginal contribution, you can forget about making a profit at all. Because all companies that have a negative marginal contribution continue to make losses, bigger and bigger and bigger losses, until at some stage the investors will lose the patience to continue funding it. So I think it all centers around these key elements and how both the incumbents and the new players think about creating the right mix of these conditions for you to be set on the path to profitability.
Thanks, Dennis, and thanks, Marc, for your insights earlier. Supaneewan, I guess from what you've heard in terms of and your experience from looking at the banking sector, we've seen in countries like Hong Kong, for example, the incumbent banks do partner with some of the non-banks for a separate digital banking license. Is that something that you guys would think about, or is that not, I guess, part of the strategy for KBank?
Yeah, I think digital banking license in Thailand have not yet clear, like what's the details. But I think we are open for, if there is a specific group target customers that we would like to capture, that we would like to have, like separated positioning and separated branded, we are open to see that opportunities. But in Thailand, it's very, I'll say that it's kind of difficult for the digital banking, because if you see all the like a statistic per se, Thailand is probably like number one that we use like mobile banking, and all the big banks that use like mobile banking, use their own mobile banking, and we're reaching like a mass scale of mobile banking users in Thailand already. And for the digital banking, I would see that there will be a specific group of the customers that we probably like be able to capture with different positionings, but it will not. It will be a bit difficult to be a mass scale. We have to see like what the differentiations of the experiences that to be able to like access them with a mass like a bigger scales in the mobile banking or digital banking. But currently in Thailand, they are starting to have like digital lending license. They just launched like a couple of months ago, and then there's like a benefit of having that products. For example, in terms of KYC, it's much easier. In terms of the KYC is easier, but you like outstanding will have like a smaller limits that you be able to offer. That one, it will be like a positioning, being able to capture some of the customers and be able to onboard those customers who are actually not yet in the market, in the lending market, like financial. To brings those non-bank to the banking ones. So I think it just depends on how BOT actually will launch digital license. What is the details in that? If it's exactly the same of the KYC, it will be a bit hard, like a difficult, and there's not much of the sense to have a separate digital banking. But if there's some of the easier in terms of the KYC, easier in terms of, like helping customers to onboarding, I think that will be positions and customers, group of customers that we should capture. So from us, we are open. It just depends on what positionings and what is actually the details of that license.
Great. Thanks so much for that. The last question I'll ask is actually from a question that's come in from the audience. Once digital banks have reached their critical mass, what do you envisage to be the revenue mix, cost to income ratio, and ROE? Basically, how different would the P&L profile look versus a conventional bank? And I'll just open this up to anyone who wants to take it.
See, one part which will be very different will be the upfront investments. So because if you see the amount of assets which the existing banks have, example is real estate. So some of the biggest buildings in CBD have bank logos on them. So that's like a lot of capital investment. So the upfront capital investment would be much lower for the new banks. So that will impact the ratio significantly. The margins will not be, what people think the margins will be less will not actually be the case, because what happens for the existing banks is they actually also have to service the mortgage market, which is a stable but the lowest return market. So in my understanding, the digital banks would not target the mortgage as the first frontier. So which is why they will go after the most profitable, most juicy segments, because there is no merits to being the full service, everything on day one. They would target the most juicy parts. So I believe in the first phase, the ratios would be much better. But the second, when they're launching and going after the most juicy segments, but when they start to become the primary bank, that's when some of those loss leaders starts to come in. And the second part is the moment they go multi-geography, because the cost of regulatory compliance is exponential cost. Every country you add, you have exponential cost increase because you have to then you are governed by more regulators for that versus when they are single market only. So, which is why I believe that the first 5 year and the 5 year plus mark will be very, very different. Specifically, the moment the loss leader products and multi-market regulatory complexity starts to creep in.
I think it's, Nicholas, very difficult to give specific numbers there, but I can speak to the overall shape of how the financial should look, right? Number one, the cost-income ratio, typically in a bank, in a large local bank, right, would be about in the 50% range. I would expect that the management team would set the cost-income ratio in the steady state to around the 30% range for a digital bank. I think the second point is in terms of the capitalization versus operating expenses. We will expect that there will be more operating expenses because, as Varun said, today you can rent a lot of the stuff. You don't need to own your own data center, for example. I do expect that in the 10-year time frame, right, a lot more banks would be operating purely on the cloud, and that would, really reduce the amount of capital expenditure. That may not necessarily be a good thing because if you're going to then, amortize it, then it basically just, means that you're going to defer your profitability for a longer period of time. But in terms of the financials, I wouldn't be so concerned about the upfront investment. I mean, that's really going to be sunk costs. The first and most critical measure is when are you going to achieve positive marginal contribution. From a fee income to interest income perspective, I think that trend is already a foregone conclusion because it has really not so much to do with the digital banks, but with competition. If you look at the shape of the NFI and NII trend over the years, and I'm sure you'll be aware of this, all signs point to the fact that NFI is declining as a mix because of competition. In the past, you could charge for a lot more fees. Today, fees are declining, and a lot of the times, the startups also would shoot themselves in the foot by then getting rid of all fees, right? And that doesn't help in terms of your financials. So we expect that the NFI will continue to fall, and NII will continue to make a bigger proportion of the overall income base. We would also expect to see bad debts, become a much smaller proportion. If you're using data correctly in the right areas, then we will expect to see an improvement in the bad debt as a percentage of your overall asset base. So I think these are the key, guidelines in terms of how you will set up the parameters. But the actual trend of when you get to profitability and what the shape looks like will really depend on the segment that you have chosen and really the strategy of how you intend to pursue that segment.
Thanks so much, Dennis and Varun, for your answers there. I'm afraid we've come to the end of the session. Would have liked to ask a few more questions on this interesting topic, but I'd just like to take the time now to thank all our panelists for sharing their views today, and to the audience as well. Thanks for tuning in.
Thank you, Nicholas.
I'll bring this session to a close. Thanks.
Yep. Thank you, Nicholas.
Thank you.